The Artemis Leading Consumer Brands Fund invests in consumer companies with leading brands, where the brand strength really is the main source of the strong consumer loyalty, the high barriers to entry, and the very healthy profitability that many of these companies enjoy, which then allows them to compound shareholder value over time. We think the best way in which companies add value for investors is by consistently returning a return on capital that's in excess of their cost of capital over time. So what we're looking for really is companies that are able to, by virtue of their brand strength, as well as their high margins and pricing power, able to consistently generate a return in excess of their cost of capital over time. So that is at the core of the fund. We're also, however, looking for newer emerging brands that can become the leading brands of tomorrow so as to never get stale. And here our approach is to really identify the drivers as well as the obstacles to growth for many of these emerging brands. And then we combine all of this using valuation. Typically, consumer brand companies are very cash generative, which allows a cash flow-based valuation approach, such as a DCF, for example, to be quite appropriate. And we like to see a minimum of 50% valuation upside over a 3-year time period in any of the companies we're investing in our portfolio. The fund is constructed in a benchmark agnostic manner with very high active share relative to the global World Equity Index benchmark. We also have a significant amount of sector concentration, given we're primarily investing in 2 sectors, the consumer discretionary and consumer staple sector. We're also concentrated by number of positions, about 30 odd, given that we want to maximize the bottom-up sources of alpha generation within the fund. We do look to minimize our risk overall by maximizing the specific company source of risk and minimizing other sources of risk. And we're on an ongoing basis monitoring factor risk attribution in order to be aware of where the risks within the portfolio lie. We pay close attention to ESG risk, given that this is a consumer brands fund and consumers increasingly are quite sensitive to matters of ESG importance and will immediately vote with their feet, perhaps via boycott, on identifying any such sources of ESG risk, which makes it especially pertinent for us to be on top of them. We look for companies with robust ESG policies and implementation on issues that are of most materiality to them, and we've also had fruitful engagement with many companies that we're invested in on ESG matters. We view this fund to be quite a useful diversifier within a core global portfolio, given its high active share as well as differentiated source of alpha generation, given its low exposure to the US market and absolutely no exposure to the Mag 7 tech stocks, for example. We also view this fund to be useful for investors seeking to capture emerging market consumer growth by way of the rising growth of the emerging middle class at a developed market cost of capital and developed market governance standards. With 5 people joining the global middle class every second, we believe that this is a theme which has a structural long-term runway for growth.